There are three things that have to match when you own property: who owns it, who's listed on the insurance policy, and who's listed on the umbrella. If those three don't line up, you can have a problem when a claim happens. This sounds simple, but it trips people up constantly because attorneys, CPAs, and insurance agents are often giving advice in their own lane without talking to each other. Your attorney tells you to put your rental property in an LLC. The CPA agrees because of the tax advantages, but nobody calls your insurance agent. And now your policy doesn't match the ownership, and you don't find out until you file a claim. I run an independent insurance agency. We write homeowners, landlord, commercial, and umbrella policies in Nevada, Arizona, Utah, and California. And the overlap between entity structure and insurance is something that creates real problems for property owners who thought they had everything set up correctly. So let's walk through how LLCs, trusts, and entity structures interact with your insurance, what works, what doesn't, and what to watch out for. The named insured on your insurance policy is the person or entity that owns the policy. They have full rights. They can make changes, file claims, and cancel the policy. And here's the important part: the named insured has to have what's called an insurable interest in the property. That means they have to be the legal owner. If the deed says one thing and the policy says another, the carrier can deny a claim. If you own a rental property in an LLC, but the insurance policy is in your personal name, there's a mismatch. The LLC owns the property. You personally don't. And when a claim is filed, the carrier can look at that and say the named insured doesn't have insurable interest. This doesn't always result in a flat denial. Sometimes it creates delays, complications, and a much harder claims process. But in some cases, it can result in a denied claim entirely. Either way, it's a problem you don't want to discover after a loss. The most common way this happens is a property owner buys a property in their personal name, binds the insurance, and then later transfers the property into an LLC or trust on their attorney's advice. They assume that the insurance follows the property. It doesn't. The policy stays in the original name unless someone updates it. If you change ownership of a property for any reason, call your insurance agency immediately before the transfer if possible. After the transfer, at the very latest, don't assume anything follows automatically. This is where most of the friction happens. Most personal lines carriers will not write a homeowners or landlord policy with an LLC as the named insured. Personal lines products are designed for individuals, not business entities. An LLC is a form of business organization, even if it only holds one rental property. Now, that doesn't mean you can't insure a property held in an LLC, but your carrier options become more limited. The carriers that do accept LLCs on personal lines typically require proof that the LLC only contains the home or rental property and nothing else. One common workaround is writing the policy in the individual's name and adding the LLC as an additional insured. This gives the LLC some liability protection under the policy, but the LLC doesn't hold the same rights as a named insured. It can complicate and delay the claims process. And the question is whether that arrangement actually gives the LLC the protection your attorney intended when they told you to set it up. This is one of those situations where the legal advice and the insurance reality don't always align cleanly. Your attorney is thinking about asset protection and liability shielding. Your insurance carrier is thinking about who owns the policy and who has insurable interest. Those two things can pull in different directions. Trusts are generally easier to work with than LLCs on personal lines. Many carriers will write a homeowner's policy with a revocable living trust as the named insured as long as the insured is the trustee. This is common for estate planning. People transfer their primary residence into a revocable trust, and the insurance can usually be updated to reflect that without too much trouble. Irrevocable trusts can be more complicated because the individual has given up ownership and control of the property. Some carriers won't write them on personal lines at all. The carrier's concern is that the named insured no longer has the same relationship to the property. The key thing is this: if you put your home or any property into a trust, you need to update the insurance policy to reflect that. If you don't, you're creating a mismatch between who owns the property and who's listed on the policy, and that can cause delays and complications in the claims process, or in some cases, a coverage issue. Some carriers require specific trust documentation before they'll make the change. Don't assume it's automatic. Tell your agent, provide whatever documentation the carrier needs, and confirm the policy has been updated. The following three terms sound similar, but they mean very different things, and getting them confused can create real problems. Named insured is the person or entity that owns the policy. Full rights can make changes, file claims, cancel coverage. Additional insured is a party that's been added to the policy for liability protection. They don't own the policy. They can't make changes or cancel it, but they do get some liability coverage under it. This is common in commercial insurance, like when a general contractor requires a subcontractor to add them as additional insured. The coverage is typically limited to liability only. Additional interest is a party that gets notified if the policy changes, lapses, or is canceled. That's it. No coverage at all. This is what a landlord is when they're listed on a tenant's renter's policy. They just get a notification if the tenant drops coverage. The confusion happens when someone thinks being listed as an additional insured or additional interest gives them the same protection as being the named insured. It doesn't. These are completely different levels of protection, and if you're relying on one when you actually need the other, you have a gap. This is probably the most common way entity and insurance problems start. An attorney advises a client to transfer rental properties into LLCs for asset protection. The legal reasoning is sound. An LLC can shield your personal assets from liability claims against the property. A CPA might agree because the entity structure has tax advantages. But neither the attorney nor the CPA is thinking about what happens to the insurance. The client follows the advice, transfers the property, and doesn't tell their insurance agent. Now the deed says LLC and the policy says individual. There's a mismatch. Or the client does tell their agent, and the agent discovers the carrier won't write the policy with the LLC as named insured. Now the client has to choose: keep the entity structure their attorney recommended, or adjust it so the insurance works. The ideal workflow is for the attorney, the CPA, and the insurance agent to coordinate before the transfer happens, not after. If all three are in the conversation from the start, you can structure things in a way that gives you the legal protection, the tax benefits, and the insurance coverage without creating gaps. If your attorney is advising you to move property into an LLC or a trust, call your insurance agent first, or at least at the same time. Don't wait until after the transfer is done. This one deserves its own section because it comes up a lot, especially online. There's a lot of content on social media telling people to put everything they own into an LLC for some asset protection. Some of that advice extends to your primary residence. Here's the insurance reality. Most personal lines carriers will not write a homeowner's policy on a primary residence held in an LLC. You may lose access to preferred rates. It can trigger underwriting issues. It can complicate your relationship with your mortgage lender. And in some states, it can interfere with homestead protections that are designed to protect your primary home from predators. Before you move your primary residence into an LLC based on something you saw online, talk to your insurance agent, talk to your attorney, and talk to your lender. Make sure all three agree it makes sense, because the insurance complications alone can create more problems than the asset protection solves. An umbrella policy provides an additional layer of liability coverage that sits on top of your underlying policies, but the umbrella only covers what it's scheduled over and what it's listed on. A personal umbrella typically follows the individual. It sits over your personal homeowner's, auto, and maybe your landlord policy. But if your rental property is held in an LLC, the personal umbrella may not extend to cover claims against that LLC. The umbrella's named insured and the entities it covers have to align. Many personal umbrellas exclude business pursuits, and depending on how the carrier classifies an LLC-held rental, that exclusion can come into play. If you have properties in both your personal name and in an LLC, you may need to explore whether a single umbrella can cover both or whether you need separate coverage. This is a conversation to have with your agent so there isn't a gap between what you think is covered and what actually is. The bottom line is this: don't assume your umbrella covers everything just because you have one. It covers what's on it. If your entities aren't on it, they may not be protected. Anytime there's a change in how your property is owned, a refinance, a title transfer, adding a spouse to the deed, moving property into a trust or LLC, your insurance needs to be reviewed. Lenders will require proof that the insurance policy matches the deed and that they're listed as mortgagee or loss payee. If you refinance and the ownership is changed, the lender may flag it. If the insurance doesn't match the new ownership structure, you could end up with a forced placed policy from the lender, which is significantly more expensive and provides less coverage. The rule is simple: anytime ownership changes, call your agent. Before the change, if you can. After the change, at the very latest, make sure the policy is updated to reflect the new reality. Here's the summary. 3 things have to match: who owns the property, who's listed as the named insured on the policy, and who's covered under the umbrella. If any of those are out of alignment, you can have a problem. LLCs on personal lines are limited. Not every carrier will write them, and the ones that do have specific requirements. Trusts are generally easier but still need to be reflected on the policy. Named insured, additional insured, and additional interest are not the same thing. Know which one you need and make sure it's set up correctly. Your attorney, CPA, and insurance agent should all be part of the conversation before you transfer property into any entity, not after. And at any time ownership changes for any reason, call your insurance agent. If you own property in Nevada, Utah, Arizona, or California, and you're not sure whether your insurance lines up with your entity structure, we can help. We work with multiple carriers across personal and commercial lines, and we understand how LLCs, trusts, and entity structures affect your coverage. We'll review your setup and make sure there aren't any gaps between who owns the property, who's on the policy, and who's actually protected. There's a link below to get a quote or just give us a call. Check out our Google reviews to see what our clients have to say. And if you're a contractor and you want to make sure your business is set up right for your entity, I made a video covering that. It's right here.